Did you know that when a bank hands you a loan, it isn't handing you existing money, but it's actually creating new money? 400 years ago, goldsmiths in Europe discovered this money-making trick. It's called fractional reserve banking. I'll explain to you how this works, but first we must see what preceded the system. So, from the 12th century, we're looking at England here, but this trend was followed in Europe in general. That's where fractional reserve banking originated. But before, from the 12th century, the monetary system was based on mainly on coinage and also tally sticks, which we'll get to. So coinage, it's pretty self-explanatory. It was minted by the crown, and the value of coinage was based on its silver content in the coins. So the average unit of account was a penny, which was about 1.5 to 2 grams of gold. And this was good because people trusted the currency, but the spending of the crown was constrained by the availability of silver. So new coins could only enter circulation if more silver deposits were made at the Royal Mint. So how it would work, someone would bring silver to the Royal Mint, the silver would get verified, then it would get stamped into a coin, which was given back to the person who brought the silver. If there's no new silver entering the country, there's no new money getting created. So so actually coins were relatively scarce. That's why during the Middle Ages you had prices going down over time because these coins became more and more scarce. So, and as well, if the crown wanted to increase their spending, they would often have to debase their currency, which they didn't want to do. Um, Debasing your currency is basically reducing the silver content in your coins. But that's not good because everyone knows that the silver content is going to get debased and prices will eventually follow, soldiers will riot, so on and so forth. So in the long run, the crown could only spend as much as they gained through taxation. But in the short term, they did use tally sticks. So say there was a war and the king did not have the coins in the treasury to pay his soldiers. He would give them tally sticks. So essentially, how we do what would happen is there would be a piece of wood. It would get snapped lengthwise, as you can see, uh, as you can see in the pictures down here. The piece of wood would get snapped, and on both sides, it would get written, for example, uh, to the holder, 10 shillings are owed. So the king would give that to a soldier, and then the soldier, when his taxes are due, he can come back to the treasury and hand in that tally stick because that's the money that's owed to him because the king wasn't able to pay him coins. And how they would know that it's real is they would join the two split parts of the tally stick, and if it joined perfectly together, then that's how you would know it was real. Because they can only match up because when it's snapped, only those two original pieces can fit back together. So it was like a tax relief, but this was only good for short-term spending because obviously if the king handed out a lot of tally sticks, his revenues for the next year would be quite low because people just give him back the tally sticks, not actual silver coin. So because of this, you had a lot of problems. Um, you had a lot of problems, as I mentioned, decreasing prices over time, money became scarce, and there wasn't much lending going on. So there was no economic growth really. Um, so eventually, a third option emerged, starting around the 15th, 16th century, and that was private money. So you had private gold smiths who held gold and silver deposits, and say you held a lot of silver, you held a lot of gold. You wouldn't want to keep it yourself. That's a risk. you could safely keep it with the goldsmith, and they might give you a return, you know, after a few years. They might give you more than you put in. And so what normally happened is that they would give you a promissory note. So normally how this promissory note would go, if you deposited 2 ounces of gold to the goldsmith, then the goldsmith would give you a promissory note, which said the holder of this note is owed 2 ounces of gold by said goldsmith, in this case, saying York goldsmith. And over time, these promissory notes became the medium of exchange because they were way more liquid, they were really easy to carry, and the unit of account could be anything, you know, they were way more divisible. It could be, you know, 0.01 ounces of gold on the promissory note. And people would accept that as a medium of exchange, as payment, because they trusted that if they went back to the goldsmith, then they would be able to get actual gold or actual silver, whatever it was on the promissory note. So this is a note from 1815. This is about the earliest I could find. The earliest found promissory note was from about 1615, a guy called Lawrence. But yeah, this is an example. So on the note it would say, you know, in this case it's 2 shillings and 6 pence, and it says, I promise to pay bearer on demand the sum of 2 shillings and 6 pence. So you would go to the person who gave you that promissory note, and they would be obligated to give you that 2 shillings and 6 pence since you had the note. So it works in the same way. So then the goldsmiths realized that not everyone is coming in at once to redeem their notes. The notes would just keep circulating. So they could actually hand out loans in promissory notes, and they could hand out more loans for money that they actually did not have. And this actually created new money. This created new money because, say, the goldsmith has 1 ounce of gold. Let's say they have 10 ounces of gold. They can actually give out 90 ounces in loans because it's doubtful that more than 10% of the people would come back and redeem their notes. You know, people just come back sometimes. So, yeah, this was essentially money creation, and the actions were not really legal of these what these goldsmiths were doing. They were not exactly legal because they didn't hold the exact metal to back every promissory note they handed out, and it wasn't considered legal tender yet by the crown. But people would still use them as a unit of exchange because they trusted that the goldsmith would have the gold in their reserves. And people were accepting of it because these goldsmiths were really the only people who were willing to lend out credit. So during this time in the 1600s, 1500s, 1600s, when this came about, you had a lot of economic growth actually, because now you had someone to lend you money if you wanted to start a shop or a business. So, so you can kind of see how fractional reserve banking is born. Um, Now, whereas before you had uh, coins, you know, silver, gold coins stamped by the crown, that was still used, but by the 1700s, or even the late 1600s, you have paper which is being exchanged. And this paper is only backed, say you have 10 shillings, this this 10 shilling promissory note is only backed by 1 or 2 shillings worth of gold back at the goldsmith who handed that to you. So in this way, new money is getting created. So So by the late 1600s, due to a series of political developments, uh, fractional reserve banking becomes the official monetary system when the Bank of England is established in 1694. And when the Bank of England building is built, they bury tally sticks. They buried tally sticks under the building to signify that the old system is gone. And you had the Promissory Notes Act in 1704. These paper notes, which are now circulating as a unit of exchange, are now made fully legal. And that's how banks started to control the economy rather than the crown itself or the central authority or the government. Now it's controlled more by commercial banks, which were goldsmiths in the old times. So yeah, as I said, these governments and individuals, now the crown itself starts borrowing from these same goldsmiths because people accept as a unit of exchange these promissory notes. It's an easy place to go and borrow. So now governments and individuals can borrow credit to fund new endeavors, to fund new businesses, or to fund wars, which actually happened a lot in the 1700s. And this was a big contributor for the big spike in economic growth you see starting from the 1700s. So how did this exactly happen? Uh, when fractional reserve banking becomes legal, I'll go over that in the next video in this series. The Glorious Revolution, the founding of the Bank of England. And yeah, this video was just to show you how fractional reserve banking actually works, how it started, and how it works very similarly today. We don't have goldsmiths anymore, but now banks have taken the place of goldsmiths. Your HSBC, your Barclays, your Citibank, your JP Morgan. And just to prove the point to you here, we have our £20 sterling note here. And what does it say if you look very closely here? I promise to pay the bearer on demand the sum of £20. So the bank doesn't actually have that £20, but it's giving you that £20 note, which is a IOU, a promissory note, a promise that if you bring that £20 note back to them, they can pay you back that £20. It's a creation. This is just a contract, but everyone accepts it as a means of exchange. Very similar to this old promissory note here, or the goldsmiths were originally handing out over here. So all of our modern banking system comes from the practice of the goldsmiths. So yeah, let me know what you think of this video, and because this is a first to me, it's not a simple topic to explain, but I'm very fascinated by this and I'm doing my best to try and help you understand what money actually is and how it works, because it's very accepted in the mainstream that like it's not really thought about what is actually money. But when you understand what money is, then you can start to make better investment decisions, better life decisions. It just helps you a lot. So yeah, I'll stop rambling now. Thank you for watching.